We just got the worst jobs report in 2 years. So in this video, I'm going to break it down for you and explain what I think this could mean for the stock market. Let's get into it. Let's start from the very top. So we just had the ADP employment change come out for June of this year, and the US lost 33,000 jobs versus the expected 95,000 jobs that economists thought would be gained. This is actually the worst jobs report since 2023. Now, if you look at that here, let me show you this chart. The last time that we had a negative growth in jobs was back in March 2023. So in fact, it's been over 2 years since then. Now, luckily enough, hopefully the forecast will stay the same, but we are expecting, or economists are expecting, that jobs will continue to increase in the future. However, why I think this is really important is because of how it could impact interest rates. We all know for a long time Trump has been pushing Jerome Powell to reduce interest rates all the way down to 1%. However, because of the tariffs, Jerome Powell hasn't been able to do that. In fact, he said that just yesterday. Powell confirms that the Fed would have cut by now if it were not for the tariffs. And the reason that they aren't able to cut, or haven't been able to cut so far, is because tariffs are going to increase prices. In other words, you're going to see an increase in inflation. Now, whether that's one-off or for a few months, only time will tell. The problem is, because the situation with tariffs is always changing, the Fed really don't know what is going to happen, and therefore they don't know what they can do about it. They have to wait and see. However, what Jerome Powell also said yesterday was that when he was asked if July would be too soon for markets to expect a rate cut, this was his answer. He answered that he really can't say, and that it's going to depend on the data. Well, guess what? We've just had really bad jobs data. The US has lost 33,000 jobs in the month of June. So if that isn't really bad data, I don't know what is. Now, this is a bigger problem because, number one, if you look at the jobs that were lost, what you will find is that actually the jobs that were lost really came from the service providing industries. This was financial services, professional and business services, and education and health services. Now, a large chunk of that, professional and business, these are white-collar jobs, high-paying white-collar jobs. And in my view, this shows the initial shift in what is going on with AI. And I do believe that a lot of these jobs that are being lost are being replaced by AI. So now we come to a situation where jobs are being lost in some industries, they're growing in others. The problem is, how can interest rates stop jobs from being lost to AI? They can't. However, at this point in time, I don't think Powell has a choice. Let's take a look at the unemployment forecast. And going into the end of the year, it was expected to be 4.4%. and increase to 4.5%. That is the unemployment rate. However, given the jobs report that we've just got for June, I think these are underestimates, and I think unemployment will rise faster than the Fed are expecting. So what can Jerome Powell and the Fed do? Well, we need to look at core inflation rate as well. Inflation has been trending down. It's still above the 2% target. However, as you can see, they're expecting inflation to increase towards the end of this year, driven primarily by tariffs. Now, if tariffs aren't as bad as they hope, then inflation might not be too bad. But we do know that tariffs have increased so far, and this is going to have a knock-on effect on prices. But this is expected to be transitory. Inflation won't sustain because it is just a one-time price increase. But this will probably be felt, over a few months. So this is the problem that the Fed have. They know pretty much that inflation is very likely to increase, but at the same time, the economy is losing jobs faster than they were hoping for. So now you're in a situation where the GDP growth rate might actually be forecasted to be too high. The growth rate might end up coming down. So you'll have this situation of low economic growth, but high inflation, at least temporarily, coming into the end of this year. The problem with reducing interest rates is that you're going to cause inflation to go up. And with inflation already close to 3%, reducing interest rates are going to make prices go up even faster. They're going to push up property prices, asset prices, and make everything more expensive. So it's going to push the normal person out of the ability to purchase a property, but to also purchase regular things. Their disposable income is going to decrease. And this is a very real problem. However, based on this employment data, it's very likely that the Fed will now be forced to act. Losing jobs, 33,000 jobs, is very dangerous because if this continues, it could cause an economic collapse. It could cause the US economy to go into a recession. So the only thing the Fed can do to try and counteract this is to reduce interest rates. So the question remains, are they going to do this sooner rather than later? Are they going to wait for the jobs report in August and see how the employment changed in July? Or are they going to make a move and reduce interest rates starting from the end of this month, being July? In my opinion, I think they are now being forced into reducing interest rates because the employment data is so much worse than they thought. However, I do think there is a risk that the cheaper money will end up being spent on AI investments anyway. So a lot of the jobs that have been lost are not going to come back. Whether or not it creates new jobs is yet to be seen, of course, but that is something that we all would hope. We'd all hope that reducing interest rates can spur back economic growth and new jobs will come to the table. Only time will tell if that happens, or if businesses will simply take the lower interest rates, take on more debt, and invest heavily into AI, which means that there will be less job creation. However, now let's get back on point. What does this mean for the stock market? Well, lower interest rates, as I alluded to, increases inflation. It will increase the price of pretty much everything because it becomes cheaper to take out more debt, and that debt can be used to pay for things. But it also means companies can take out debt more cheaply and funnel that money into buying assets, including stocks. So I do believe that this is going to be bullish for the US stock market, and this is also why it's now important that people remain invested in it, because as we've seen in the past, when interest rates come down, more money gets printed because more money is cheaper, and this is going to push up asset prices, including stocks. So if you like the video, please leave a thumbs up, and I will see you on the next one.